The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A global bond sell-off stopping the rally in its tracks. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Katie Greifeld.
And I'm Miss Ebel. We're kicking you off through The Close today, Katie. It's finally Friday. It's been a wild week, so this is where we stand. We're looking at an S&P that's down for the day, 0.8%. But for the week, we're seeing huge gains. It's on track for its 7th weekly gain, which is the longest stretch since 2023. 10-year yield, this is the big story you see there. We're almost close to the 4.6%. More on that later, but again, this is the marker we need to watch. Definitely a big story there. And you're seeing crude up by, let's call it 3.5%, around $109 per barrel. So we're seeing stocks pricing in all the AI productivity, yields pricing in some inflation risks, and we have oil pricing in tight supply. Which one is right? And let's not forget the dollar up by maybe 0.5%. That's the best week since March.
Well, let's talk a little bit more about the bond market today, because what you mentioned, those inflation concerns tied to high oil prices bubbling back up today, sending bond yields around the world soaring. The U.S. 30-year yield seeing its largest weekly surge since 2025. A feverish send-off for outgoing Fed Chair Jerome Powell, whose term as chair ends today, stepping aside in a particularly complex moment for the central bank as it braces for Kevin Warsh to take the reins.
I do think the Fed will have to face some very difficult decisions. The pace right now of inflation, let's say it's 4, let's say it's 4.5, let's say it's 5%. The Fed's target is 2. So you can't maintain an easing bias, at least in the short run.
Now that bond breakdown spiraling into a tech wreck, with many of the recent gainers sharply reversing. Ford, perhaps the most glaring example of that AI fever dream, cracking today alongside fellow sufferers, including NVIDIA. But that's still not enough to throw the Nasdaq 100 off its course, with the index still on pace for its best quarter since 2020. But those inflation concerns, they aren't going anywhere as President Donald Trump returns from his summit in Beijing without a breakthrough on the pivotal Strait of Hormuz, saying he didn't push China President Xi Jinping to pressure Tehran for a resolution. Now, one strategist telling Bloomberg that today's action reflects markets adjusting to the reality of stickier inflation for longer. Isabel, perhaps what we're seeing work its way through the bond market right now.
This, I think, is such a phenomenal chart because we're looking at a U.S. 10-year yield. So every day this week, it just inched higher. And on Wednesday, it topped 4.5%. And look at today, we're probably going to hit 4.6%. So this is the highest since 2025. And on a weekly basis, we also saw the biggest gain since 2025. And obviously, this benchmark is important because a lot of loans are benchmarked to this. Also, mortgage rates. As a renter, of course, I always look at this. And if you look at it, we're looking at a bond market that's concerned about inflation, concerned about more rate hikes, concerned about government debt. And this comes at a time that incoming Fed Chair Kevin Warsh will be the new leader. So definitely an early test for him, Katie.
Absolutely. Well, let's kick things off with Andrew Slimmon. He is Senior Portfolio Manager at Morgan Stanley Investment Management. Andrew, great to see you. We've been talking all week about when we're going to see that sell-off in the bond market start to act as maybe a braking mechanism of sorts when it comes to this equity market rally that we've seen. And I wonder whether you see any traces of that in today's market action.
I'm happy it's happening, Katie, because the fever in the speculative NASDAQ stocks was getting extreme. And we need to cool that off before it's even more painful correction. So I didn't know what it was going to be. I guess it's higher rates, but I knew that the market was ripe for some bad news to knock it back. And I wouldn't be surprised if this is just the beginning of, a weak period.
Well, put a weak period into context for us. Like you said, you wouldn't be surprised if maybe, what we're seeing today had some legs behind it. But, I mean, how much of a drawdown of a weak period might you be looking for here?
Well, that's a good question, Kate. So, look, I think the market it's rotating, I like to say, from the macro to the micro back to the macro. In the first quarter, the market was weak because we were focused on macro issues. But then, so far in the second quarter until today, it was all about earnings, strong. And now we're pivoting to kind of back to macro issues. So I don't think the sell-off will be extreme because earnings are coming in very, very strongly. Yes, some of the consumer stocks have been weak as worries of retail being hurt or consumers being hurt by higher gas prices. But overall, the earnings are really supporting the market, but I think it's overbought. So could we get, 5-10%, another 9% like we had in the first quarter? I think that's possible, but I have a hard time more than that simply because the earnings estimates for this year and next keep going up. I just followed them before I came on. The numbers for this year and next are yet again they're higher, and that's supportive of stocks ultimately. But we just got too overbought, and this takes a little bit of the fever down, and I think that's good news.
You say that, Andrew, tech valuations are reasonable, not euphoric, but that's not what a lot of investors believe. Why do you think they are wrong? It's kind of hard to reconcile because you also say that sentiment is depressed, but markets are at near records.
Sure, absolutely. Let me start with your second, Isabella, which is when I say sentiment, I mean consumer sentiment is really very, very weak. Investor sentiment is mixed. The AI bull-bear ratio is not very bullish, but then the put-call ratio is pretty bullish. So investor sentiment is mixed, but consumer sentiment is very, very, very weak. As it pertains to tech stocks, look, there is a fever in some of these memory stocks and semiconductor stocks, but if you look at their valuation, they're not that extreme. A lot of them are selling at single-digit multiples. And that's because the market knows these are very volatile earnings, and as much as they're going up, they can reverse the other way. So I think the market and investors are acting rational and not overpaying for these outsized earnings right now, especially in these memory stocks. That's why they're at single digit. Doesn't mean they can't go down a lot if that E or perception of earnings suddenly reverses, but I don't think it's extreme. And then if I look at the big guys, the Mag 7, I mean, they're trading in the low 20 multiples for the revenue growth they just posted, most of them in the first quarter. They're not that expensive. So I think there's been a little bit of a frenzy move in these stocks, but I don't think valuations, anyone that says, oh, this is like 99, 2000, I was around. That is not the case.
What would actually make you turn defensive on equities from here on out?
Well, I think you'd have to see valuations on tech stocks get a lot more expensive than they are currently. I just don't think the valuations are extreme yet. The sentiment towards them has gotten a little frothy, so I think it's healthy to bring down some of this investor sentiment. But I don't think the valuations are extreme. And so usually bubbles peak when you get extreme valuation, extreme sentiment. Remember, in the year when the dot-com bubble blew, it was because some of these most popular stocks, they started missing quarters and saying the numbers were too high. That's not what we're seeing today. These companies are all producing, above expectation results.
All right, Andrew, really appreciate you taking the time on this Friday. Have a great weekend when you get there. That is Andrew Slimmon. He is Senior Portfolio Manager at Morgan Stanley Investment Management. And coming up, he was the former Assistant U.S. Trade Representative for China and says that President Trump's trade deal with Beijing looks all too familiar. We'll unpack the president's visit to China and the lingering implications with Jeff Moon, president of China Moon Strategies.
Plus, back in our hemisphere, we're tracking a major developing story around Canada's oil and gas industry. We'll drill down on the latest with Enbridge CEO Greg Ebel and Alberta Premier Danielle Smith.
And it'll behoove you not to miss our conversation with Kentucky Derby winning trainer Cherie DeVaux, the first woman to ever claim the title. We're just a trot, skip, and a jump away from all that and more. Coming up, happy Friday. This is The Close on Bloomberg.
President Trump currently en route back to Washington after his two-day visit to China. The president confirming today he has made no commitment to Chinese President Xi Jinping over Taiwan and that he would make a decision soon over a planned $14 billion arms deal with the island. Xi Jinping warning the two nations could descend into conflict based on the outcome with Taiwan. Here with his perspective is Jeff Moon, president of China Moon Strategies and former assistant U.S. Trade Representative for China. Thank you so much for joining us, Jeff. So what is your biggest takeaway from this trip? Because last I checked, the two sides have not released any detailed outcomes from that trip.
U.S.-China summits are always positive in the sense that they give the two leaders a chance to talk, exchange views, and prevent misunderstandings. The top priority this time was to promote stability in the relationship, and they seem to be successful in that regard. But beyond that, this was a low-ambition summit that achieved low-ambition results. I think this is the result of lack of preparation. These summits usually take months to prepare, and by all accounts, things were rushed, particularly on the U.S. end. And frankly, the deliverables on the commercial side that are being announced, Trump was offered and refused similar deals, better deals, at the beginning of his first term. So I'm not sure how far we've come in terms of trade progress in the agenda.
Low ambition summit. In your view, what could have made it a high ambition summit? Or better yet, do you think it should have happened at all, given that it was a low ambition summit?
Well, they should have scoped out better what the results were going to be, what deliverables both sides was prepared to offer. You know, the fact that there were no statements offered at the end of the visit suggests to me minimal preparation and certainly minimal coordination. And in the past, these things, the number of Boeing jets and other things have been lined up well in advance before people get on the plane to go to China. And that just apparently didn't happen here for reasons that are not necessarily clear.
Well, we saw reporting today that President Xi Jinping is set to visit the U.S. come the autumn. So I wonder, how this, what you're calling a low ambition summit, how does that set the stage for the coming months and whether or not we could actually see some substantial signs of progress come autumn?
Well, there are a couple of things here. One is that it was very interesting that Trump invited him on a very specific date, September 24th, which suggested sort of to me that maybe there was some notional agreement on that date. The other two visits that are going to happen are in conjunction with multilateral events, APEC being one of them. These are events that the U.S. and China were going to be at the same place, and so why shouldn't the leaders meet? That's what happened in Busan, South Korea last year. So the question is, why would you schedule a summit meeting in the foreign capital rather than rely on those sort of, let's call them, casual interactions that you would have at normally scheduled events? I'm not sure why Trump didn't, instead of taking this trip, do that, rely on some other kind of event where they could have meet. And I'm not sure why there's going to be a return visit if there isn't significant progress. If we have another summit similar to what we have here with few tangible results, I don't think that's a good optic for either side.
Well, two of the big elephants in the room here were, of course, Iran and Taiwan. And when it comes to Iran, you saw both the Trump administration and Xi Jinping and China overall basically projecting alignment there when it comes to the Strait of Hormuz, that they share the goal of opening up the strait. On Taiwan, though, obviously, things are a little bit different, not exactly in alignment there. And I wonder, how you think that sort of influenced the tone of the summit and the fact that there weren't any real concrete deliverables.
Taiwan has always been, according to Chinese officials in every official meeting I've ever attended, they will tell you that Taiwan is the most important and most sensitive issue in U.S.-China relations. So those statements are nothing new. I think it was the emotion surrounding those statements in the context of this summit that were particularly interesting. And I think, frankly, that Xi Jinping is under pressure to achieve some kind of results on Taiwan. And given that he has nothing to lose in terms of Trump pushing back, I think he decided to push back even harder. And I suspect that the meager commercial results that came out of this are the result of Trump standing firm and not changing Taiwan policy, which was the right thing to do.
Who do you think came out as the bigger winner? Was it President Trump or Xi Jinping?
I think Xi Jinping probably came out better than Trump did in this case. I think that the attitude that he projected, the excessive praise, the fawning upon China and Xi Jinping, I think really diminished Trump's stature at this meeting. I think that he's gone from extreme to extreme. Last year, at the height of the trade war, He had very volatile rhetoric about China. This time, he's gone to the other extreme. I think he needs to find a tone that's somewhere in the middle, a little more businesslike, and that would suit American purposes much better.
All right, Jeff, great to catch up with you and on the heels of this summit. That is Jeff Moon. He is the president at China Moon Strategies and former assistant U.S. trade representative for China. Now, coming up, the big kahuna of tech and AI set to report results next week. We're going to chip away at the potential outcomes of those NVIDIA results with an analyst who covers the stock next. This is The Close on Bloomberg. It's time now for our top calls. We'll look at some of the big movers on the back of analyst recommendations. And first up, Texas Roadhouse, RBC, getting a taste for the restaurant chain, upgrading the stock to outperform from sector perform and raising its price target to $210 from $180. The analyst is bullish on beef prices, seeing potential for costs to be less unfavorable, driving upside to investor margin expectations. Shares higher by about 1%. Next in line, Viking. Morgan Stanley cutting the cruise line to equal weight from overweight, but raising the sales on its price target to $86 from $81. The analyst is anticipating the back of a stronger 2027 booking curve will more than offset near-term cost pressures, saying the bank continues to be favorable of Viking long-term. You can see shares down about 3.4% though. And finally, Applied Materials. Analysts reacting to the chipmaker's latest quarterly report, with several banks upping price targets, including Jefferies, which increased its target to $510 from $415, also maintaining its buy rating. The analyst saying the key takeaways of the report was increased confidence on the durability of extending growth, but you can see shares pretty much unchanged at the moment, and those are some of our top calls. Now let's stay in the chip space here, because the biggest name of them all, reporting results next Wednesday after the bell. Even with growing tech concerns hitting the markets this year, NVIDIA still up significantly for 2026. Let's break it down with Stacy Rasgon. He is Managing Director and Senior Analyst of U.S. Semiconductors and Semiconductor Capital Equipment over at Bernstein Research. Stacy, great to have you with us. It's been an interesting couple of months for NVIDIA when you think about how the stock has performed since October. So it does look like some of the sheen has come off, but maybe regaining a little bit of its footing. Where do you expect these results to land when it comes to sort of resetting the narrative around NVIDIA?
Yeah, you bet. And you're right. NVIDIA, it's done fine year to date, but lots of other things have done a lot better in the space. Semis have just been on a tear since the beginning of the year. Part of the issue is that AI has been dragging everything else, in the sector along with it. We went from the GPUs and accelerators at one point, but then it was memory and semicap and optical and power semis, and now it's CPUs. And I think there's been a preference among investors to play more of those other names in the supply chain, like kind of the constraint names, rather than the raw AI compute names. And it sort of opened up this kind of interesting divergence between the two, because one of them is clearly wrong, right? I mean, the rest of the supply chain can't work long term if the compute names are not delivering. And so this is one reason that we've actually liked NVIDIA, because I do think that there is an opportunity for that narrative to reset and that gap to normalize it at some point. And frankly, over the last couple of weeks, we've started to see it. Like it hasn't been dramatic, but I mean, the stock actually has been creeping up, and I can't remember, it's up 25 or 30% or something like that over the last several weeks. Not dramatically, but like a little at a time. It's been doing really well as we go into the earnings. And I think as we go into earnings, I mean, look, numbers are already clearly low. Jensen at GTC a couple of months ago already sort of put out a target for just some of their data center products, what they call Blackwell and Rubin, to cover $1 trillion from calendar 25 to calendar 27. That would put you at almost $500 billion in calendar 27 just for those products. Wouldn't include other products that they're selling and other segments, and the street is already like below that number. So I actually do think that there is an opportunity here for that narrative to, as you say, to reset, for numbers to start to reflect a more realistic scenario as AI demand is clearly off the charts. And hopefully people get comfortable with the sustainability of it. There's room for the multiple, I think, to re-rate back up as well.
So we have growth that keeps accelerating, but China is still constrained. Do you think that NVIDIA even needs China? Because I ask especially because Jensen Huang was a late addition to this trip of President Donald Trump, and many were
expecting
there
apparently. Right? He's eating his way through Beijing, I guess.
Do you think that NVIDIA still needs China?
Yes and no. I mean, so they've taken China out of the numbers, so it's not there, and so that's fine. So anything they get from China is upside. So they don't need China like from that standpoint in terms of to make the estimates. Now there are strategic reasons clearly that beyond just the numbers that I think they should be in China. And so this idea, I kind of agree with NVIDIA and with Jensen on the idea of them being able, hopefully longer term, to sell older generation products. I mean, you kind of want a presence. If you're not there at all, China's not going to give up on AI like one way or the other. If you're not going to allow NVIDIA and other US players to be there, China is going to find their own way. And you encourage the growth of a local ecosystem and encourage local developers to coalesce around that local ecosystem and give it scale. I actually do think it is better strategically to allow the U.S. Players to compete, even if it's with older generation products. And I know there's still some, there's not full agreement on this, like in the U.S. on the government side. And then even in China, Jensen's actually had licenses to ship some of this stuff, but the Chinese government, even though the Chinese customers have wanted the parts, the Chinese government has not been all that eager to allow it because, again, they're trying to encourage the growth of those local players.
Right.
I am hopeful strategically that Jensen and NVIDIA and others will be able to sell at least some stuff in China. Do they actually need it to make the numbers? No, they don't.
Right.
They've taken.
Stacey, we only have about 30 seconds off with you, and I really want to ask you about, the big IPO we saw this week, Cerebras, being pitched basically as an NVIDIA competitor. And again, in these 30 seconds that we have with you, I mean, how big is NVIDIA's competitive moat at the moment? Has it narrowed at all?
It's pretty big, right? And look, I mean, there's always concern about market share, and I know Cerebras went today, but yeah, there's Broadcom and there's AMD and there's others, and frankly, they're all doing fine, right? I mean, Broadcom said, Broadcom guided, they said they're going to do $100 billion in AI revenue next year. They'll probably do more, and AMD is picking up, and I don't really concern myself all that much right now with who's winning or losing. I think the broader question right now is the opportunity still big or is it not?
Right.
If it's still big, everybody's thriving. If it's not big, everybody's screwed. So, I mean, that's sort of the question. I think it's big right now. It's clearly still big.
All right, Stacy, great to get a preview with you. Have a great weekend. That is Stacy Rasgon joining us, of course, from Bernstein Research. Coming up next, we're going to major news out of Canada that could fire up the global natural gas market. This is The Close. Just about 3:30 p.m. in New York. This is the countdown to The Close. I'm Katie Greifeld.
And I'm Isabel Lee.
And we're keeping an eye on these equity markets, but also on the oil markets as well, the energy markets more broadly. Isabel, obviously, that has been the story over the past 2 months or so and continues to dominate the headlines.
I haven't really given natural gas much thought, but in the past months I have been. And you have President Donald Trump making conflicting remarks on the Strait of Hormuz. He told Fox News that the U.S. doesn't need waterways to open. So it really makes you wonder how that will affect gas prices.
Absolutely. And you think about what natural gas futures are doing today, closing higher. Apparently, weekly government data showing a smaller than expected addition to domestic stockpiles. So certainly a concern when you think about what the direction of travel is. But speaking of natural gas, big news affecting the energy space coming out of Canada today. The federal and Alberta governments have advanced a new carbon tax. Now, this is a key step towards federal support for a new pipeline that would run from the province to Canada's west coast. Enbridge, it's one of North America's largest energy infrastructure companies, has been consulting on the pipeline project. And I'm pleased to say that the company's president and CEO, Greg Ebel, he joins us in studio. Greg, it's great to see you.
Katie, Isabel, great to be here.
So to start, let's talk about this agreement, obviously, a long time in the making here, and would just love to hear your reaction, whether you think, there were any surprising elements here, and whether you think this timetable is actually realistic.
Well, look, first of all, I think it's an important step forward. For a long time, probably the last decade, the federal government and the Alberta government had been at odds, to say the least. In fact, one might almost say all-out war of words on this issue. And they've come together. and they've put forward a plan that hopefully will allow more production. We'll have to see. That's up for the producers, my customers, to decide whether they like this deal. That will allow for more pipelines to be built, which I'm interested in. And so that's a big step forward for Canada. And it comes at a right time. You were both talking not just natural gas, but oil. North America is just full of that, as you know, and it creates a real opportunity. And Canada largely sends its oil to the United States. Send some off the West Coast. But these deals allow us to build more pipelines to the United States, which is great for consumers here and industry here, but also to move oil off the West Coast eventually. We'll have to see how long that takes, but it's a step in the right direction.
Absolutely. And I wonder, how this factors into your business, because, you've gone back and forth here on whether you'd be open to becoming a proponent of this pipeline. And, now that we do have the backing of Carney's government in exchange, of course, for that carbon tax, is this something that you would consider?
Well, it's definitely positive. And one has to remember, we actually did propose the pipeline, had it approved, spent $600 million, which got lit on fire by government agencies.
That was a decade ago, right?
A decade ago. But it still stings at $600 million. But look, hopefully that attitude has changed. It's a new day, a new government. So we definitely would consider it. In the meantime, we continue to build pipelines, some 430,000 barrels a day of new pipeline that will come to the United States by 2028. That's great for, as I said, consumers down here. But look, we've gone from a backlog at Enbridge of $26 billion of projects in gas and oil and even renewables just 14 months ago to $40 billion. So we have lots to do, but we're always open to doing more as the largest energy infrastructure company in North America.
And we're hearing concerns about carbon costs, but also the growing demand because of geopolitical instability. Which do you think is winning the argument right now?
Well, we'll see. Canada would be the only country of the top 10 producers that actually has a carbon charge of this nature. So we'll have to see what that impact is on producers. At the same time, Canada produces oil cheaper than just about anybody else and has low carbon already. So I think combined with the needs, combined with the desire between the federal government and the provincial government, and if my customers want to go somewhere, that's my job, to be able to find interconnections and build pipeline to those markets.
I'm curious, does the Iran conflict fundamentally strengthen the case for Canada's energy exports?
Well, I think the Iran conflict actually fundamentally creates fortress energy North America. So it strengthens the position both for the United States and Canada. One has to remember, 5 million barrels approximately a day come from Canada to the United States. That allows the United States to project energy power off the Gulf Coast. So when we're producing oil in the Permian region, think about Texas, then we're able to ship that offshore as Canadian oil comes down, is used in the refineries here to produce products. Now, fortunately, Enbridge is also the largest exporter of oil out of the United States at Corpus Christi in the United States. So it's changed the full dynamic. It's full on for North America. It's an exciting opportunity. I think Premier Smith has seen that for a number of years, and I believe that the Prime Minister recognizes that Canada has a big role to play, and if it wants to be an energy superpower, it's got to be able to build infrastructure. It's got to create an environment that its producers feel that they can make money at as well, and we'll see. It's definitely a page flip.
Premier Smith, who of course will be joining us in just a few minutes. I do want to talk just about the price of oil overall, because you think about Brent, we're trading near 109 right now. That feels pretty common, or feels somewhat normal, but you think about, where we were in February, as recently as late February, and it is a sea change of difference. And I wonder, whether we should expect to stay around these sorts of levels for the foreseeable future, or, what are you working through over at Enbridge?
Yeah, so fortunately at Enbridge, we move the product, we get paid to move the product, so I don't make any more or less money on the price. But I'm not agnostic to it, obviously. If the price of oil is too high for you and I to use in our vehicles or industry and stuff, that's going to hurt demand. So we're definitely watching it. But look, I think this hopefully is a short-term issue, and then you'll see oil retreat back more to fundamentals as opposed to a risk premium. Maybe there is $8 or $10 from that base of where we are, say, in January, of a risk premium now. But again, that probably is good for North American energy companies. I would argue good for North American consumers, given what we have. have, and good for infrastructure companies. You were talking about natural gas a little bit earlier on. Think about, because we have so much natural gas in North America, because we do have gas pipelines throughout North America, that the price of natural gas in North America has not moved since the Iran war. But it's grown dramatically for the Asians and for the Europeans. So it's a good example with good infrastructure, with good resource. You can keep that price low. Oil's a little different. It's priced off the world, but we've got a great opportunity to ship more oil, more natural gas through LNG. You often talk about that. And I think that's good for business and ultimately, a little challenging right now, but ultimately good for the consumer too.
All right, Greg, well, really appreciate you making the time to come to studio with us. That is Greg Ebel. He is Enbridge President and CEO. And as teased, let's continue this discussion now on the carbon price deal and the Alberta pipeline with Alberta Premier Danielle Smith. Premier Smith, great to have you with us. So as I said, a monumental day here, some big news when it comes to the energy markets. And I want to talk about how, if at all, the Iran war sort of factors in here, whether or not this makes the economics of this new pipeline project maybe a little bit better.
It certainly does. I think what has happened out of the Strait of Hormuz disruption is that a lot of the Asian markets have realized they need to diversify where they get their energy from. And I have even talked to one ambassador who said, you know, the Strait of Hormuz could be closed once, it could be closed again. And so that's part of the reason why they're looking to develop new relationships with new suppliers, and why I think it's more important than ever that we build a second pipeline off the west coast of Canada. We already have Trans Mountain Pipeline, which is serving some of those Asian markets, but we think essentially that they will take whatever amount of energy we're able to provide to them, and it will act as a hedge against that insecurity of what might happen in the Middle East.
And so let's talk a little bit about how this pipeline gets built, because your government is doing the initial planning here, but you've said that this should be built by the private sector. And I wonder, you know, what that looks like, you know, how confident you are that you can get energy companies or that you can get private equity to sort of step up here and sign on for a project that is estimated to be pretty large.
Well, I think it'll be three parts. So one part is going to be Indigenous ownership. As you know, we've developed a relationship with our Indigenous peoples where we underwrite loan guarantees for major infrastructure investments, and Canada has done the same. So we both have the ability to allow for the nations along the route to take an equity stake. So that's where I think that both the provincial and federal government will have a stake. Then of course, you will have a pipeline company like you just spoke with Greg Ebel. I saw either he or Trans Mountain Pipeline or South Bow or another proponent would also take a stake. And then we also suspect that there'll be some interest in the buyers themselves. We've seen this model with LNG Canada, where it was a consortium of Asian buyers who essentially provided the capital in order to build that project because they're going to be the ultimate recipients. So that's what we would be anticipating. It would be some combination of those, but it had to begin with a sense of certainty that it could be built. We had an unfortunate situation with the Keystone XL pipeline where the presidential permit got canceled. That cost our government $1.5 billion, but it also cost the industry. We've had other projects that went $1 billion into the regulatory process and ended up pulling the plug because of no chance of getting approval. So having the guarantee that you've got the provincial and federal government working together and we're committed to making this work, we think that there'll be several different private interests that will ultimately line up to build it.
Well, to that point, I do want to talk a little bit about how the oil producers in your country feel about this, because, you know, we've heard a lot from the industry when it comes to carbon pricing. And as I understand it, Canada is really the only major oil producing nation that has a tax like this. So, I mean, what have your conversations with those companies sounded like? And especially now that there is a plan to increase the tax that they pay?
Yeah, well, I would say that we've had this kind of carbon pricing on large emitters in Alberta since 2007. It's those who emit over 100,000 megatons a year. So it's actually quite narrow on the very large major producers who would be paying it. The question we always had is how much would it cost to comply? If under the old regime, it was going up to $170 by 2030, we've managed to negotiate with the federal government a slower rise to 130 by 2035, which we calculate will save the industry about $250 billion worth of compliance costs over the lifetime of this agreement from the status quo. That's a lot of money freed up to be able to invest in technologies, to be able to invest in expanding their production. And so we're going to continue talking with the producers. That's sort of the next phase of this negotiation as we work out the carbon capture, utilization, and storage project that the Pathways group of companies, the oil sands group, has proposed. But we think that this is certainly a sea change improvement over where we were before this was signed.
Well, Premier Smith, let's talk a little bit about timelines. And I want to start with the first deadline, and that is July 1st here when you submit the pipeline proposal. How confident are you that you're going to have a private sector proponent in place when you do submit that?
I would say that we have to be clear about what the pipeline route would be. And we've been working with 3 pipeline companies to understand the economics of that, the engineering behind that. So all of our major pipeline companies are at the table giving us advice. And then when we have it approved on the major projects list, which the government has given us an undertaking for conditional approval October the 1st. And then the work begins, of course, with the consultation with the Indigenous groups and working out in some of the environmental accommodations that will need to be made along the route, with the idea that by September 2027, we'd be ready for shovels in the ground. Now, we will continue to walk with the companies all the way through to that final investment or to that ultimate approval. But I would anticipate at some point by the time it's approved in September 2027, we'll have a pretty clear idea of who the various partners will be who will build it on our behalf.
Well, that's the second part I wanted to introduce, September 2027, when you might actually start the construction of this new pipeline. I mean, how confident are you around that date, or is that something that you would expect to maybe shift around a little bit here?
Well, we have to move quickly. I mean, I've watched with great appreciation as the U.S. administration has issued several presidential permits for multiple pipelines going south. You just spoke with Enbridge. They have many permit approvals that will allow for them to do continued expansion, including of their mainline 400,000 barrels. South Bow and Bridger are partnered on a project that also received presidential permit approvals. And so we're looking with great interest at the speed with which the American administration has been able to move, and realize that we have a particular advantage in being able to get pipeline to the West Coast and feed that Asian market. We're about 8 to 10 days away from some of those Asian markets. We already have established with TMX that there is a thirst and a demand for it. And so that's part of the reason why we think we have to move quickly. I think with the disruption in the Strait of Hormuz, the urgency has really elevated with all of those potential buyers.
And Premier Smith, I only have about a minute left with you before a hard break, but I want to talk a little bit about the separatist movement in your province, because there's a group that does want independence. They've submitted a petition looking for a referendum. This week, a court blocked it. You were unhappy with that decision, and I wonder if the courts do continue to block this petition, will your government step in and put this question to your voters?
Well, I'm worried about the court blocking all citizens' actions. I look at it more broadly, that we want to be permissive to allow people to put forward issues that are angering them so that we can have a good open debate on them. So I do feel that the court overreached, which is why we want to preserve the legislation and preserve that pathway. But for my part, I support remaining in Canada. I support Alberta autonomy within Canada and a cooperative federalism. And that's a demonstration of what you saw today, is that when we have disagreement, we come together, we sign an agreement, and we do something that's good for us as well as for the entire country.
All right, well, we really appreciate your time on a busy day. That is Alberta Premier Danielle Smith. This is The Close on Bloomberg. Welcome back to The Close. I'm Katie Greifeld alongside Isabel Lee in for Romaine Bostic. Happy Friday, Isabel.
Happy Friday. I'm so excited to be here, especially because it's with Katie. We're looking at a market that's really quite interesting. We have the S&P on track for its 7th straight winning streak. It's down for today, down bad actually by more than 1%. But for the week, it's up for its 7th weekly winning streak. I think that's the best since 2023. And of course, the big story here is the bond market. You have 10-year yield there, almost at 4.6%. So that's really the big story of the day. Exactly. And then oil is also in the green, as is the dollar. I think that's the best week since March.
Yeah, but as you said, I mean, the S&P 500 down bad, crying at the gym. Yeah. For more market analysis, let's welcome in Aoifinn Devitt. She is Managing Director of Global Wealth over at Moneta. Aoifinn, great to see you in person.
Thank you. Great to be here.
So let's talk a little bit about what we're seeing today, because you have yields up. That's not necessarily new, but stocks down. That does feel a little bit new relative to recent performance. And I wonder, is this just a delayed reaction to all of the inflation data that we got this week? When you think about CPI, you think about PPI, and just the idea that these inflationary pressures, they might be around for a while.
I'm going to put it down to a bit of jet lag. We've all been focused on the affair, the theater, really, that's been playing out in China. There was a lot of expectation built into that. We were expecting a breakthrough on the diplomatic front, a breakthrough with some trade talks. We had the whole good coterie of tech leaders going there, maybe expecting some big announcement around supply. And we didn't really get anything. We got a lot of theater, but not much. And I could put it down to a bit of jet lag following that. We've all been looking at that. We know these negative symptoms have been building up. And now markets have decided hitting all-time highs when we have these concerns in the rearview mirror, maybe that's not such a good combination.
You know, and we opened up the show with Andrew Slimmon, who said that maybe today is more than just, some risk-off movement into the weekend. Maybe this is the start of a weaker period for risk assets. And I wonder, if that is something that you agree with.
I don't think it's a weaker period. We've had these two things coexisting for some time. This record earnings season, S&P earnings up 27.7%, when the normal beat would be around 12, 13, 14. So this is really astronomical. This is an average. We've just, on the back of that, that is going to have some significant tailwind. We know the negatives are there. The bond market is telling us that. They're quite spooked about inflation. We're not talking about rate cuts anymore. We're talking about potentially one hike. We have a new Fed chairman to contend with. We don't know what that style is going to be. Will he communicate well and transparently and often, as the previous chair has done? And his markets now, are they weaned on that? Are they expecting this constant telegraphing? This attitude of no surprises, or how will they fare? So that's a bit of uncertainty there. On the international front, we have bond yields in the UK at 28-year highs. So we clearly have some, let's say, a fallout regarding the fiscal situation there. So overall, there's quite a lot. We have also consumer sentiment at an all-time low. So these factors now are just chipping away at some of that enthusiasm. But still, I don't expect a protracted period of risk off because of those earnings.
So earnings have been phenomenal, but if you look at it, it's bifurcated because everything AI is butterflies and roses and rainbows. But the other side, you see some concerns mixed in with Iran and oil. And at what point does the AI enthusiasm, in your view, become more speculative than fundamental?
What I see on AI is a rotation away from the big, say, the Mag 7 stocks into, we've certainly seen the semiconductors already. We've spoken about the infrastructure, picks and shovels trade. Now the next rotation is actually something that Mark Cuban called out some time ago on X, which was around this mid-cap segment that was poised to have their leg up with AI, their productivity enhancements. We even saw the OpenAI and Anthropic do that with their consultants, consortia, putting together in order to get that into the mid-cap. So that is another form of rotation that we think will take place. There will be exuberance coming out of the market. There is no question that exuberance was priced to perfection. But I don't see, and I see also financials will, because following the money, if these large companies need to fund their capex, they will clearly need to raise money to do that. Financials are in a very good state. So I do see lots of other sectors. Healthcare, all this hiring has all been in healthcare. So all these other sectors have lots of strong fundamentals behind them. So I think that's what the rotation will look like.
Where do you see a mispricing in the market? Because stocks are pricing in productivity, bonds are pricing in inflation risks, oil are pricing in a tight supply backdrop. I mean, those three aspects can all be correct.
That's true. I would suggest the bonds have perhaps overdone it slightly. I think we are not going to have a rate hike. I think we know that the midterms are coming. We know there is a desire to manage expectations around the economy there. We know the consumer is hurting. And this can only go on for so long. So while there will be some steam coming out of the equity market, I do think that perhaps we're pricing the most bearish scenario possible with fixed income right now.
Yeah, absolutely. And to that point, I mean, is there a level that you think will ultimately act as the ceiling when you take a look at what's going on, particularly in the long end of the curve, where 30-year yields have certainly reached some pretty lofty thresholds this week?
Yeah, I think we are getting close to that ceiling now. I mean, we haven't had much discussion from the administration around the bond prices or around interest rates. There's been kind of a silence regarding that for some time. Perhaps the focus has been on geopolitics, on the trip to China. I expect now when we have a rotation back into domestic politics next week, but there will be some attention on that. The inflation numbers were poor and were shocking, but whereas the employment numbers were also strong. So all of these things could actually play together to be a slightly overheating economy, but then we have the consumer sentiment being so low. So there will be a desire, I think, to state a course when it comes to interest rates. So that's probably, I don't expect us to see much movement in bond prices beyond this.
Absolutely. Well, let's talk a little bit about what this means for Kevin Warsh. Of course, this is the day that marks the end of Chairman Jerome Powell's head out of the central bank. We know that Kevin Warsh is inheriting a very tricky economic backdrop. Some people have written off rate cuts for 2026 completely from here. Where do you stand?
You might call it a poison chalice that he has inherited. Probably not the most, I suppose, comfortable set, not a Goldilocks scenario, certainly. He's obviously very experienced. He has a very clear vision for how the Fed should conduct itself. I would expect that he will take some time to perhaps off the spotlight. Nothing urgent has to be done one way or the other at the moment. He should take stock, build alliances, build goodwill, and ultimately forge some kind of path with the watchers, the Fed watchers, who, as I mentioned, are now expecting a much more steady diet of communication that he's likely to give. So he needs to set the tone, and I would not suggest any big bang movements coming out of that. Taking time, because as I said, nothing urgent needs to be done right now.
Yeah, and as we keep getting reminded, of course, the chairperson's vote is just one of 12. So certainly a game of politics, soft politics, in addition to policy. Aoifinn, great to see you. Have a wonderful weekend.
Thank you.
That is Aoifinn Devitt. She is Managing Director of Global Wealth over at Moneta. As we count down to the closing bells here, it looks like we're going to finish up off session lows, but still quite depressed, Isabel.
It's definitely interesting. We have Goldman saying the biggest risk to the macro picture still is when the Iran war won't remain solved and the flow of oil. So even if we're seeing all this enthusiasm, there's still some risk out there. Absolutely.
Well, we are moving closer and closer to the closing bells on this Friday. Full market coverage right here on Bloomberg. It starts with a global simulcast right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
About 2 minutes away from the end of the trading day on this Friday afternoon, Katie Greifeld and Isabel Lee in for Romaine Bostick. And here to help take us through the closing bell, it's a global simulcast. We're joined now by Carol Massar and Tim Stenovic. We bring together all of our various audiences to talk about this drawdown in the S&P 500, Carol. We were just discussing whether or not this was sort of a delayed reaction to all of the hot inflation prints that we've gotten this week.
Tim has been, like you've been saying over and over, it's like, why today did all of a sudden equities decide to react?
Or why did bonds decide to react today?
The global bond market, right? Like, why today did they catch up with the news?
I mean, maybe oil is, a little part of the story, but we've seen these numbers before. Brent contracts to $109 a barrel.
Is it because nothing came out of the U.S.-China?
WTI, $105.60 a barrel.
I mean, you could say maybe it's Friday. Maybe people don't want to hold risk into the weekend, but certainly we've seen plenty of Fridays where that isn't the case, but certainly some sheen coming off this rally, Isabel.
Our guest earlier just said maybe people are waking up to the jet lag, so maybe there is that. And we had a note just come in minutes ago from Keith Lerner saying that this is a Teflon market. I mean, there are few risks starting to stick, but maybe overall people are still optimistic. But yeah, maybe they're just realizing and they decided to react once and for all.
Well, when bond yields start to move up, you start looking against that against other asset classes or investments or what you get in terms of a yield on the S&P 500. You start to, kind of can make these comparisons. So we'll see what investors do.
Absolutely. We'll see, if we get any truth socials, too, from the president. We know that he has cared about the bond market in his second term, but crickets so far. Meanwhile, we take a look at how we're closing on this Friday afternoon. The S&P 500 looks like we're going to finish about 1.2% lower. Remember this time yesterday, we were talking about 7,500 on the big index. You can see that's closer to 7,400 today. The NASDAQ also down by about 1.5%. The Dow down as well. The little guys also taking it on the chin as well, with the Russell 2000 firmly in the red, Carol.
All right, let's go back to the S&P 500. Just doing a refresh here on my Bloomberg. Most names in the index lower today. 360 names in the S&P 500, guys, losing ground on this Friday. 141 to the upside. And Isabel, you had 2 unchanged.
Looking at the IMAP, it's mostly red, but you see pockets of green energy up by around 0.7%, but the rest is really down. Tech is down by nearly 2%, materials down by nearly 3%, health is also down by 1%, and the list goes on, but definitely mostly red there on your screen.
Yeah, a ton of red there. All right, so let's go to some of the gainers in today's session, and I'm going to go to the number one gainer in the S&P and the NASDAQ 100 today, and that is Dexcom. Ticker is DXCM. That stock up at its highs more than 9% today, but still finishing with a gain of about 6.5% for the Friday trade. This is after the maker of continuous glucose monitoring devices gave a long-term growth outlook at its investor day that impressed analysts. You also had the activist investor Elliott Investment Management taking a stake in the company and struck a settlement that will put 2 independent directors on the board. That deal stipulates the two will collaborate to appoint those 2 new directors who will add board expertise in medical technologies and operations to help the company scale. So keep in mind, a little perspective here. The market cap for this company peaked above $63 billion back in 2021. It's declined since then and has about a $23 billion market cap today. And we've seen it cut its revenue outlook in recent years, citing some execution problems. We also saw a new CEO take over in January, the former CEO becoming executive chair. So they've had a lot going on. But nonetheless, this was a much more bullish day for Dexcom in today's session. Let's flip it on over to, those glucose monitors. I want to credit my co-host, who's just brilliant.
Oh,
and he's
Where is he?
He's like, you got to do Dexcom, and then you got to do this next story because you got to talk about ice cream because sometimes people who eat ice cream have to have these glucose.
I didn't say that part.
Well,
Sounds like you did.
I just thought it would pair nicely.
For no reason.
It's like a fine wine.
I'm going to get to pizza in a moment because you could also, tie this together. Let's talk about Magnum ice cream. We did see this stock move up almost 11% here at the close, finishing just off its highs, the most since the stock's December listing. Reuters reported that the private equity firms, including Blackstone and Clayton, Dubilier and Rice, are exploring potential bids for the company. Reuters citing people familiar with the matter, saying that the firms are monitoring Magnum's share price, waiting for summer sales before deciding whether or not to pursue bids. Company spokesman declined to comment to Bloomberg. We should point out this record intraday rally coming after Unilever spun off Magnum ice cream in a triple listing in Amsterdam, London, and New York in December.
Yummy.
But they own Ben & Jerry's. They own, I think, Klondike's. And
More of
Magnum.
a froyo kind of gal.
Are you? Froyo.
Nothing like original tart, no flavor.
Puppies like froyo, too.
Oh, no kidding.
Just going to put that out there. All right. In keeping with this theme, you have some ice cream. Sometimes you have ice cream after pizza. Sometimes you have ice cream before pizza in my house. All right. So Papa John's also higher in today's session, just up almost 6.2%. This is, again, Reuters. Wow, they've been working hard. Reuters reported investment firm Earth Capital working with the pizza chain's largest U.S. franchisee, who controls around 10% of its domestic restaurants, to take the company private. Reuters cited 3 sources, which it did not identify. So, this is going on. So we'll see what happens with this one.
Okay.
I'm just hungry now.
How about some socks?
Okay.
To eat?
No, you can't eat these chips. But the Philadelphia Semiconductor Index off its worst levels today, but still closed down 4%. In fact, you had only 4 stocks in the socks actually move higher today. Skyworks, Qorvo, Astera, and Qualcomm. ARM Holdings fell more than 8.4%. Nova fell 8.4%. You had Intel fall 6%. Look, the socks is still up this year, more than 60%, but a little bit of a give back in chip names today. Next, let's talk about Ford. After surging more than 21% in the last couple of days, Ford shares are taking a bit of a breather, finishing down today by 7.5%. It's actually the most in more than a year. A bit of a cooling in the enthusiasm over Ford's potential to benefit from the boom in energy demand for AI. Remember, it was Ford's energy storage business and possible future tie-up with AI hyperscalers that led to this rally. Still, even with today's decline, Ford shares are still more than 11% higher since the close on Tuesday. That was the day before the rally started. And speaking of rallies fizzling, Cerebras Systems, after yesterday's blockbuster IPO, I think we could call it, shares fell today by just about 10%, still closing the day at about $280 per share. Remember, it was $185. That was the IPO price, and they did close higher yesterday by about 70%, Katie.
All right, well, let's take a look at the bond market, which was on fire in a bad way. today. You can see that sell-off really taking place throughout the curve from the short end to the long end. You can see the 10-year yields rose by 11 basis points, a similar amount when it comes to the 20-year Treasury yield as well. For both the 10-year and the 30-year yield, we're looking at the highest levels in about a year here. The 30-year yield well above 5% at this point. The 10-year Treasury yield just kissing about 4.6%. It's going to be interesting to see, if this sort of sell-off momentum continues into next week, or whether, again, this is just a risk-off sort of Friday. Don't want to be too long headed into the weekend, but certainly some eye-catching moves and levels themselves.
Yeah, no doubt about it. Also eye-catching, we talk so much about the $90 trillion great wealth transfer, that massive shift from the older generation as they pass it on to maybe their wives or their kids or their grandkids. Well, part of this massive wealth transfer also includes a lot of old cars, vintage cars, collectible cars, and we're calling it the vehicular spin on this great wealth transfer. And it's a lot of money.
Well, Haggerty estimates that 12 million enthusiast vehicles will transfer to a new generation in the U.S. over the next 15 years. It represents about $570 billion worth of cars. If you think about it, passing a car on to another has deep implications. People describe their cars in this story. They inherited them. They're totems that mark important people in their life, and certainly how they're remembered. And Alex Roy is somebody, Hannah has done a great piece for Bloomberg Business Week, Hannah Elliott, and you got to listen to her podcast with Matt Miller. But she talks to a car enthusiast, Alex Roy, who he's an entrepreneur too, but he talks about how he regrets selling his father's Cadillac and his mother's Porsche, so now he's going to hold on to this 1970 Citroen that his brother left behind to him.
Wow. Well, I would certainly hang on to that. But speaking of wealth, another story on the terminal today. An anonymous bidder paid $9 million to have lunch with the likes of Warren Buffett, as well as Steph Curry, as well as his wife, Ayesha Curry. Of course, this is all for charity, but $9 million. This lunch is apparently going to happen on June 24th. It's going to include the winner, again, anonymous, and 7 guests as well.
How come Steph Curry gets to go this year?
I don't really know.
How come it's gone down in price? Was it the last auction in 2022? An anonymous person spent a record $19 million to secure?
That is wild.
And this is happening in Omaha instead of New York this time, right? Because it used to happen in New York.
That is true.
Maybe
There's
that
so many
was worth
questions.
$10 million.
What are they going to eat, and where is this going to be?
I'm guessing steak.
And I want the transcript, so
I'm guessing if you steak, Coca-Cola,
right?
Salad,
yeah.
Salad,
maybe some See's candies for dessert.
Delicious, delicious.
Yeah.
Yeah, we'll see. But this annual lunch has been happening or Buffett has been routinely hosting some sort of lunch auction for more than 2 decades here. So the tradition continues.
It's for charity.
It's for charity. It's for a good cause.
Super sweet. Yeah. Love it that it continues on. All right, guys, we have to move on. That is a wrap for the Friday edition of The Closing Bell, our cross-platform radio, TV, YouTube, Bloomberg Originals. Katie and Isabel continuing there, of course, on The Close on Bloomberg Television. Tim and I right back here on Bloomberg Business Week Daily on Bloomberg Radio. We will see you same time, same place on Monday.
And coming up, a guide to alternatives in the second half of the year. Aaron Mulvihill, he is global alternative strategist over at JP Morgan Asset Management. He joins us shortly. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Isabel Lee. So let's take a look at where the markets closed out today. We're looking at an S&P that ended really down by 1.5%, or maybe 1.3%. Let's be kinder. But for the week, it was a gain, and we're looking at 7 straight weeks of gains, the longest winning streak since at least 2023. And then you're looking at 10-year yields. It's now 4.6. Oh, now it's 4.59. But still, that also is another big story of the day. You can see a lot of inflation fears feeding into the bond market. And we're looking also at oil higher by 3.5%, and the dollar up by 0.5%. Katie.
Well, let's take a look at some of the day's biggest movers on the single stock level. And we start with Microsoft. You can see shares rising by about 3%. That was your biggest contributor to the upside on the S&P 500 in terms of points. Not that it was enough to drag the index out of the doldrums. One of the big losers, as we were discussing in the simulcast, is Ford, down about 7.5%. There has been so much excitement around their energy business, but fizzling a little bit today. And NVIDIA reports next week, and it is consequential. But you can see on this Friday, a down day for the market, made worse by NVIDIA's drop of 4.4%. But it's time now for our weekly ETF wrap. And I'm very excited to bring you this chart from Bloomberg Intelligence showing that fewer companies are highly owned by active funds. In white there, you can see highly owned by passive funds. That bar has been going up over the past decade or so. And then in orange there, you have highly owned by active funds. That bar continues to drop. So let's talk about it with James Seyffart of Bloomberg Intelligence. He joins us now. So James, great to have you with us. First of all, set the scene for us. What exactly does high active ownership mean in the context of this chart, and how does it typically translate into stock returns?
Yeah, so thanks for having me, Katie and Isabel. The way we quantify this is any stock that has more than 30% of its shares owned by passive funds in aggregate, so that's mutual funds or ETFs, or active funds, mutual funds and ETFs. And as you said, it's going down dramatically on the active side and rising dramatically on the passive side. But when you look at both of these, there's a correlation here. Like as you look at very low active ownership or even very low passive ownership, like those tend to be highly risky stocks that don't tend to perform very well at all. So if you look at the worst category or the lowest category of active ownership, it actually has had negative returns over the past 12 months and over the last 3 years. Like same thing with passive ownership. So when you're looking at these things at the extremes, it's on the low end, it's not good. And at the extremes on the high end, it tends to be very good. They tend to dramatically outperform the market, particularly if you see increasing numbers of active ownership on underlying stocks.
And we know that big ETF managers, you cover this on a day-to-day basis, James, and Katie and I love to look at them too. I mean, they're getting bigger and bigger, the likes of BlackRock and Vanguard. What does it mean, though, for active managers in this space then?
Yeah, so I mean, one thing I would say is that they have to find more unique ways to, theoretically earn alpha or get ahead of these passive funds. And one way we've seen it when we do this analysis, a good example is UL Solutions is a product that a company that was added to the midcap, the S&P midcap 400 in December of this past year. It was at the top of our list for active ownership, and it was performing very well. It still performed very well over a 3-year time period, but it's dropped off the top list because it got added to the mid-cap and started going up on passive ownership. So basically, if these active managers can get in front of this passive buying, that's one way that they're finding the ability to eke out alpha.
All right, James, great research as always. You can find James' research on the terminal at BIETF Go. That is James Seyffart of Bloomberg Intelligence. And great news, you can keep up to date with the latest ETF news by subscribing to my newsletter. It's called ETF IQ. Great news, you can subscribe at bloomberg.com/ETF IQ newsletter. That link is handy. And Isabel, I'm thrilled to say that the newsletter has been published.
And I read it. It was about a corgi, and it was fun. I saw the interview also on Monday. So good job.
A lot of photos in there. Everyone should go look at it.
One photo was with Katie, and T's an Invesco leader. Anyway, from one BI expert to another, let's bring in Chris Cain for another edition of Factor Friday, breaking down the factors to watch. Thank you so much for joining us in person, Chris. So I guess the first question is, talk to us about the AI trades and what trade do you specifically see that is working the best?
Yeah, so we did a couple pieces, kind of deep dives on AI this week. So our AI basket is 43 stocks. So this is stocks that are both in the S&P 500 as well as our Bloomberg AI index. That's an index that was formed by our great thematic team at BI. So these stocks are up, 20% just since the beginning of April, the AI stocks, compared to just a couple percentage points for the rest of the index. But it's kind of interesting. When you look under the hood, it's really not a monolith. It's really the infrastructure plays are the ones working, things like hardware, things like semis. Further down the AI supply chain, like the software names really are not working. Some of them are even down. So it's not just enough to pick AI names. You kind of got to pick the right ones.
Absolutely. It's not a monolith there. Let's talk a little bit about valuations. We're seeing a little bit of a deflation here, but when you think about valuations overall, when it comes to AI, how many people are throwing around the bubble word? Can we use that?
A lot of people are saying that. I feel like it's becoming almost fashionable to say we're in a bubble, AI's a bubble, this is like tech bubble 2.0. I honestly don't see it. When you look at the valuations, looking at forward PEs of these AI stocks versus the index, they're only about 30% more expensive. That's actually cheaper than average over the last 5 years. They've averaged about 45% more expensive. They were as expensive as 70% more expensive. So it's kind of interesting when you think these stocks are outperforming everything else, and they're getting cheaper. So what's that tell you? It tells you that the EPS growth is even faster than the price growth. For example, the street now expects these AI stocks to grow earnings at over 40% for the rest of the year, compared to 13% for the index. Call it triple the growth. So these things are both outperforming everything else and getting cheaper. So I don't see a bubble, at least not right now.
Once in a while with my Bloomberg terminal, Katie, I do FTW Go, so factors to watch. And I'm curious, where does the AI play fit into there, and how is it affecting these traditional factors? I think Bloomberg, at least, has around 12.
Yes. So it's obviously affecting most factors, but really the one that stands out is, as you would guess, momentum. So momentum has really been on a historic run this year. Long-short momentum is up 30%, meaning high momentum stocks have beaten low momentum stocks by over 30% this year. That's in the 99th percentile of all rolling 6-month returns over the last 25 years. It's not just AI, but AI is certainly pushing that. So momentum has really been the standout.
Well, Chris Cain, we always appreciate your perspective digging into the factors. That is Chris Cain of Bloomberg Intelligence. Now, coming up, the pressures on private credit and where JP Morgan Asset Management sees opportunity outside of equities. We'll catch up with the firm's global alternative strategist, Erin Mulvihill, next. This is The Close on Bloomberg. Welcome back to The Close. We do want to bring you some breaking news dropping in the last few minutes, and that is that BlackRock's private credit funds valuations are being probed by the DOJ. This is according to people with knowledge of the matter, that federal prosecutors are scrutinizing valuation practices at a BlackRock private credit fund. That is the BlackRock TCP Capital Corp. That is a publicly traded BDC, and part of this probe reportedly has involved bringing in executives for questioning, Isabel.
And we have Jay Clayton, Southern District of New York spokesperson. He said in November he was concerned about how firms value private assets. I mean, we've heard this time and again here in Bloomberg that, how do they do this? Because it's different. We've seen a lot of redemptions, and it's definitely one hot topic that we always read about.
Absolutely, and you can see BlackRock shares moving a little bit lower after hours. We're going to continue to follow this story, but we do want to sort of continue the conversation here because AI-related equities may have had a rough end to the week, but in private markets, there's still all the rage, with nearly 90% of all venture capitals now going to AI companies, according to our next guest. So let's discuss the technology's potential to reshape private markets and where the opportunities lie with Erin Mulvihill. He is global alternative strategist over at JP Morgan Asset Management. Erin, it's great to see you again.
Great to be here.
So I do want to talk about AI, but I do first want to talk about private credit valuation, since obviously that is very much in the market's mind right now. And in the notes that you sent over to our producers, you do write that, you think about the elevated redemption requests that we saw in the first quarter, really putting liquidity and putting valuation practices under the microscope here. And I suppose, from the investor standpoint, that's only set to continue.
You're right. Under the microscope is a good way to put it. We've had a number of challenges in private credit. I would say perception challenges rather than fundamental challenges when we really look at the industry's performance overall. You've had software has been in the news quite a bit recently, and that started, of course, with the SaaS apocalypse, and then in equity markets. And then investors looked at private credit's exposure to software, where we estimate it's between 20 to 40% of private credit funds. But I think what's important to keep in mind here is private credit is a very large industry. It's about a $2.7 trillion asset class today. And so for investors that are concerned about software or particular funds or particular sectors, there's a lot of other areas to find opportunities.
You made a distinction there. You said perception. So talk to us about how you think private credit is doing right now. With news like these, I know you can't talk about specific funds, but then what does it tell you? I mean, obviously now we have government intervening or at least probing. Where are we in that stage right now when it comes to concerns of investors?
So when we look at broader private credit, it's a really large space. You've got concerns maybe around software, around particular funds. If we look at asset-backed credit, one of the fastest growing areas of private credit, that's where we see a lot of investors leaning into now. So thinking about credit that's backed by collateral, backed by infrastructure, backed by real estate. This is a really fast-growing area. And then other parts of private credit we're quite positive on would be distressed debt, because if you are concerned about private credit, if you're concerned about a credit crunch or an economic downturn, distressed debt is an area that can outperform in this situation.
Well, let's talk a little bit, too, about AI since, we wrapped up the Magnificent Seven earnings. We do have NVIDIA next week, though. And, you think about what we're seeing in the public markets. Finally, some of these names coming out of the pipeline. Cerebra is certainly well received. But talk to us about what the funding landscape looks like when it comes to the private markets in some of these AI companies. Yeah,
it's likely to be a mega year for IPOs and for M&A. I think we started the year off really strong. It's probably going to be a year a little bit like last year, where we started off strong. Q2 maybe a little bit challenged because of the geopolitical issues and the war and so on, but we feel really good about quarter 3 and 4. When you look at AI, a lot of the development of AI right now, the application layer, if you will, is happening in venture capital. So these are companies that are not listed, they're not available for public investment. And when we look at how long it's taking private companies to list, the average over the last couple of years has been 12 years. And so if you think about that, a company that's starting to develop AI next generation technology today in the private markets, we might not see that company available for investment until mid-2030s, maybe 2040s.
All right, Aaron, unfortunately, we're up against the clock and have to leave it there. Come back soon. That is Aaron Mulvihill. He is Global Alternative Strategist over at JP Morgan Asset Management. And it is going to be interesting to see when we get to some of the second quarter redemption requests, whether or not they match, exceed, or are less than some of the levels that we saw in the first quarter.
Definitely. Hindsight is always clearer. I would be interested in that. And also SaaSpocalypse and how that really... It's how much is the damage really affecting AI? I think that's one of the things we talked about, and Aaron also mentioned.
Absolutely. Well, coming up next, we're going to pivot in a big way and talk about the big business behind horse racing. Kentucky Derby winning trader Cherie DeVaux joins us after the break, going to talk about how you build a Kentucky Derby winner and also her decision to not run Golden Tempo in the Preakness. That conversation coming up next. This is The Close on Bloomberg. While the horse racing world turns to Baltimore for tomorrow's Preakness Stakes, executive editor David Papadopoulos warns that the second leg of the Triple Crown could be, quote, fading into oblivion as the Derby winner, Golden Tempo, skips the race. And this is the second year in a row that this has happened. I'm pleased to say that David is here in the Bloomberg offices on a Friday afternoon, and he joins me now. David Papadopoulos, talk to us about this, because this is not just the second time this has happened. This is the third time in 5 years.
Yeah, third time in 5 years. Basically never used to happen. I mean, if you had the Derby winner, you as a trainer, you as an owner, you took your horse to the Preakness, and you were trying to follow up your Derby win with a win in the Preakness, and then hopefully ultimately a win in the Belmont Stakes, and to have your horse, enter into the Hall of the all-time greats as a Triple Crown winner. But the Derby, the Preakness, the Belmont are spaced tightly together. And modern trainers today, like our current Kentucky Derby winning trainer, Cherie DeVaux, they simply just don't want to run their horses that close to each other. They don't want to run every 2 weeks. They want to run once a month, once every 5 weeks, once every 6 weeks. Times change and training methods change, and so the Triple Crown's sort of got a problem right now.
Yeah, and this has implications not just for the horse racing world, but also you think about if there's not a Triple Crown contention, that means less casual fans tuning in and watching these races on TV. And I have to imagine some of the TV networks and the advertisers aren't thrilled about that.
I can't imagine that NBC, which carries the Derby and the Preakness, is too happy about this. You do have 14 horses, Katie, if you'd like to bet on it. 14 horses going into the starting gate tomorrow for the Preakness. It's pretty much a group of randos and wannabes. There are no stars in this group. Who knows? Maybe one of them will emerge as the next star. But not only is the Derby winner not there, the runner-up in the Derby is not there, and 4 of the top 5 horses in the Derby are all skipping the race.
Absolutely. Well, let's keep this conversation going with Kentucky Derby winning trainer Cherie DeVaux joining us right now. Cherie, a pleasure to talk to you. So you think about your decision not to run Golden Tempo in the Preakness. This really sort of pierced outside the world of horse racing. You saw the decision making the rounds on social media. So, I'd love to hear from you, straight from the horse trainer's mouth. I mean, why you made this decision, what ultimately led you there, what the decision tree actually looked like.
Okay, so there were multiple factors, and I'm sure it wasn't meant to be phrased that we just don't want to run the horses. We just have a lot more tools at our disposal. We use speed figures to see how fast horses move forward from their last race now. And the ultimate decision was just, were we going to focus on the Triple Crown for Golden Tempo, or are we going to focus on his year? Because the Triple Crown does take a unique type of horse and a special horse. Golden Tempo did a lot from his last race in Louisiana to the Kentucky Derby. And he's a horse that's very much on the upward trajectory. Coming back, we very rarely run these horses back in 2 weeks, as you said. So that was our decision. He's done a lot. If we want to have a horse for the summer and the rest of the year, the Triple Crown Pass is going to take a lot out of him. And other things that's not part of the discussion that I can shed light on is we're under a whole new set of regulations and rules. Mm-hmm. So some of the things that you could do to help the horse within the rules, how they were, we can't do now. So, we really have to give the horses time to rest, and they're 100%, they have to be 100% sound. They have to be moving well. And if they're not in that 2 weeks, there's nothing therapeutically really that we can do to help them get there. That's not the case with us, but that is a determining factor in a lot of decision making.
Cherie, first of all, I want to congratulate you on winning the Derby. Your celebration was fantastic. Anytime I even have a $2 winner at the track, that's also the way I celebrate. So we've watched it many times in my house. I want to ask you this. 2 weeks, right, you decided was too quick back for this horse. And there's a lot of chatter out there about, what Maryland racing officials need to do to get the Preakness the attention that it once had and they wanted to have again. What kind of time frame would work for you? Like, in other words, so you're not targeting the Preakness, you did not target the Preakness. If it were 3 weeks between the Derby and the Preakness, would you have targeted the race? If it were 4 weeks, 5 weeks, what would it require for Cherie DeVaux to say, hey, yeah, I think we can point him to that race?
Well, definitely more spacing, but we're talking the Triple Crown. I actually respect the process because to be a Triple Crown winner, you have to be a special horse to be able to do it. It's, that is a special, tough horse. And I'm not saying Golden Tempo is not tough. He's just not ready to come back in 2 weeks. So is it 3 weeks? Could it be 3 weeks? Possibly. That would have changed our decision. Also, this Triple Crown season is different. It's at Laurel. It's not at Pimlico. So you got a couple of different factors in this year. It's just not traditionally the same. We're also having it at Saratoga at 1.25 miles. And the Belmont is at Saratoga at 1.25 miles instead of 1.5 miles. So this is a unique Triple Crown year for all 3 legs.
So now,
well, the second 2.
Cherie, do you look at the field that's been entered for the Preakness and say to yourself, man, I could be 2-1 in the Preakness Stakes. Maybe I should have entered him.
No, I'm pretty good, and it wasn't just my decision. It was a collective decision with the ownership group and myself, and it was a collective conversation. But we have to make our decision and stand by it, and just stand firm in that instead of thinking, what if we did.
Well, one of those owners that you mentioned is, of course, Vinny Viola. He is the co-founder of Virtu Financial. But Cherie, I think it's interesting that, it's not just you in isolation who has made this decision. As we were chatting about before you joined us, I mean, we've seen 3 of the past 5 Kentucky Derby winners opt not to race in the Preakness. And as we say at Bloomberg News, 3 makes a trend. So I do wonder, in your view, whether, you do think it's a possibility that the timetable changes here, whether or not we could actually see the Preakness get pushed out a little bit.
Well, that would change my decision, but I'm also, I want to drive it firm that the Triple Crown, to me, maybe if they want more participants and viewers, yes, it needs to change. But for it to be a true test of champions, the way it is, as it stands, is a real true test of champions in 5 weeks.
Cherie, a couple other questions for you. So tell us, how is the horse doing as he prepares for the Belmont Stakes up at Saratoga this year? And then separately, I will note that you do, while you don't have a horse in the Preakness, you do have a horse earlier in the day. You have Reagan's Honor running in the Sir Barton. And tell our viewers, I mean, we're looking to make some money this weekend. Should everybody go out and bet on Reagan's Honor in the Sir Barton?
Okay, well, we'll start with Golden Tempo, who had a nice and easy workout this morning. So just getting his legs back under him, getting him back in the groove. He worked really well. So we'll start to increase his workload every week until we are about a week away from the Belmont. And then, unfortunately, in the Sir Barton, we were very excited to run Reagan's Honor, but he shipped in and he got a fever, so we had to, and he was quite sick. So he got there, and his body said no, thank you. So I appreciate the well wishes, but we are scratched out of the race.
Well, Cherie, as a horse lover myself, so cool to get to speak to you. That is Cherie DeVaux. She is Kentucky Derby winning trainer. And of course, our big thanks to David Papadopoulos. He is an executive editor over at Bloomberg News and a voter in the Thoroughbred Industry's Eclipse Awards. David, have a great weekend.
You too, Katie. Thanks.
Let's talk quickly about how markets closed on this Friday. We're taking a look at Macy's here. After actually looking at the after hours, I believe we got some 13F news. You can see Macy's moving higher by about 4% right now. So too is Delta, higher by about 3% after hours. And United Health Group, what a ride for this company. You can see down about 3.8% after hours after Berkshire exits. We're going to continue to follow that. This is The Close on Bloomberg. Retail results on deck, offering a fresh read on the state of the consumer. Target, TJX, and Walmart all set to post earnings throughout the coming week. Mari Shor, she is a senior equities analyst over at Columbia Threadneedle. She joins us now to discuss. And Mari, let's start with Walmart, because we're in a really interesting economic environment. You have, of course, the hyperscalers, the AI names absolutely booming right now. Can't necessarily say the same for the consumer-facing businesses, consumers which are being hit from inflation on all sides right now. How does that sort of set the deck for Walmart, which tends to benefit, it feels like, from a trade down environment?
Absolutely. Thank you for having me. I think what we're seeing across retail right now is a low single growth market where there is a widening gap between the winners and losers. And Walmart is certainly a winner. We typically see Walmart act more defensively in a tough macro backdrop. But now, with their growth in e-commerce and a lot of the higher margin businesses, like advertising and membership that are growing as a result of e-commerce, we see Walmart operating more on the offense and feel increasingly confident in their ability to continue to take share across category, channel, and income demographic.
Well, you take a look at the stock's performance. I mean, it's higher by about 18% on a total return basis year to date, outpacing the S&P 500 and its industry peer group overall. And I wonder, when you think about what this company might deliver in terms of guidance, in terms of their look ahead, is that going to be enough to sustain the rally that we've seen?
Yes, I would expect a modest guidance raise from Walmart given the continued top line strength and growth of some of these higher margin, newer businesses that I just alluded to. But remember, Walmart and all the retailers are facing increased freight and distribution costs as gas prices have increased. So I would expect a muted increase to their earnings guidance. They were very conservative when they first provided this guidance, especially in terms of their FX assumptions. So I would expect a bit of an increase there. And I also would say that last quarter, when they announced a $30 billion repurchase authorization, I think that really shows management's confidence in the business and also that they believe the stock is a good buy even at these levels.
Well, I also want to talk about how this backdrop that we're seeing, how that translates into the likes of TJX, which of course is an off-price retailer. You know, some of the tailwinds that might be benefiting Walmart here, does that also extend rather to the likes of TJX?
Yes, I mean, TJX has put up remarkably consistent performance, and we continue to see real strength from them across their concepts, notably home goods. And I would say, just stepping back, we continue to see the off-price retailers take share from the full price channel. And so with TJX too, I think the guidance they provided was incredibly conservative, and they too should be able to beat earnings in the first quarter and also raise guidance for the full year. But I would just highlight that the off-price business does tend to be more sensitive to freight costs, just given the nature of their business. So there may be a bit more of a headwind here from the recent increase in energy prices.
Absolutely. Well, Mari, before we let you go, quickly give us your expectations for Target, also reporting next week, also on quite a tear when you take a look at their year-to-date performance as well.
Yeah, I think Target is one of the most highly anticipated names into earnings. As you said, expectations and the stock have risen significantly. And I think really the question from here is, will Target be able to sustain this kind of comp momentum? On the positive side, they do have some new merchandising initiatives that are just starting to benefit the top line. But on the other hand, higher energy prices, more difficult comparisons, and continued share loss, I think will limit the comp upside. And it seems that given the higher expectations on the name, they need to deliver around 3% comps for the remainder of the full year in order to drive the type of earnings upside to full year guidance that the bulls are looking for here.
All right, Mari, great to preview some of these big names with you. That is Mari Shor. She is senior equities analyst over at Columbia Threadneedle's Investments. Meanwhile, we want to stick with earnings because the main event comes on Wednesday when NVIDIA gets set to report their results. Danielle Flax, he is senior research analyst over at Neuberger Berman. He joins us now to discuss. Dan, great to have you with us. And NVIDIA is an interesting one, right? Because until April, the stock was really going nowhere from October on. And it feels like even still there are sort of, mixed narratives when it comes to this name. So just give us the lay of the land here, what your expectations are for this behemoth.
Great to be with you, as always. We're expecting a very strong report driven by their data center business. This is a company growing 80 to 90%. And what's really most important, in my view, is this continued execution on their product cycles. You have Blackwell, their current platform in the data center, which is incredibly healthy, very strong customer demand. And as we move into the second part of this calendar year, you're going to see Rubin ramp. And so I think what's important is this driving innovation across their systems, their ecosystem with millions of developers remains vibrant. In the very near term, they're continuing to try to add capacity as quickly as possible, and they are supply constrained. And so I think that will be a factor in terms of their report. and the guidance. But the market, I think, with each passing month is seeing the benefit of their innovation in areas like, for example, agents with their cloud customers. So new growth opportunities, in my view, will help this name continue to outperform over the next several months and into next year.
Well, I do want to bring you into a conversation we were having with Stacy Rasgon last hour, and that is sort of the competitive position of NVIDIA, because everyone likes to talk about new competitors, of course, to the incumbent here, which is NVIDIA. We saw Cerebras, that IPO, get a stunning reception this week, a company that's been positioned as, an NVIDIA competitors here. You still have, stalwarts such as Broadcom, also named as challengers, and the competitive moat that NVIDIA has built over the past several years. I mean, how strong is it still?
I think the competition remains fierce, but I think what's important here is that this market is expanding. And as we move into this next period of innovation, particularly with inference, a lot of the customers, the cloud customers, sovereigns, enterprises, they're realizing returns from a lot of these investments. And so, yes, the market is certainly broader than NVIDIA. Broadcom is becoming increasingly strategic to key cloud customers such as Google, Meta as another example. Those companies, by the way, of course, remain very large and growing customers with NVIDIA. You have AMD, which is continuing to execute very well under CEO Lisa Su and the leadership team. And so I expect the competition to remain fierce. But I think at the moment we're in this period where the market is expanding, and I think NVIDIA is going to continue to lead, which sets the company up well as I think about the year ahead.
Well, on this show, we often talk about the Ouroboros of spending that we see among the big tech companies, basically funneling money all at each other. NVIDIA, obviously, a beneficiary of that. And I wonder, when you think about the CapEx numbers that we got out of some of their peers in the Magnificent Seven, whether or not you think that those spending levels are sustainable at this juncture.
Well, what's important is that if you're looking at companies like, for example, Microsoft with their Azure platform, Amazon Web Services, Google Cloud, those companies are investing aggressively with NVIDIA, and then they're turning around and realizing strong returns in their cloud businesses, which is causing them to continue to raise their capital expenditures. And of course, they're spending with NVIDIA as well. I see that continuing over the next 12 to 24 months. And while spending can certainly be lumpy, we are seeing the returns in the cloud. And so in my view, that will help determine just how strong the business can be for NVIDIA. But if, assuming they're executing well and assuming their customers are seeing the returns in cloud, I think that bodes well for those customers and, of course, NVIDIA as well.
Well, NVIDIA shares higher by about 21% year to date. A lot of those gains coming in April. Going to be fascinating to get those numbers on Wednesday. Daniel, really appreciate you stopping by. That is Daniel Flax. He is senior research analyst over at Neuberger Berman. Now, still ahead, what investors need to watch for over the next week, we'll tell you next. This is The Close on Bloomberg. Happy Friday. Let's look ahead to what else we're watching over the next week. On Monday, the G7 finance ministers and central banks meet in Paris. It's also my birthday on May 18th. I will be in Ireland, not in Paris. But more importantly, on Tuesday, Home Depot reports earnings. We also have Google's annual developer conference and congressional primaries in some states. And then that takes us to Wednesday, a make or break moment for the stock market with NVIDIA earnings. Expectations certainly high there, especially when it comes to the direction of the overall market. Plus, we also have the Fed releasing minutes from its last meeting. Then Thursday, we have Walmart earnings, an important read on the state of the U.S. consumer. The fact that we're going to get some U.S. economic data certainly adds to that picture. And in the Eurozone, we're also going to get some consumer confidence figures as well. That brings us to Friday. We get the University of Michigan consumer sentiment reading. Overseas, we also get UK consumer confidence as well as Japanese CPI. But that does it for us here on The Close. Balance of Power is up next. Have a great weekend. This is Bloomberg.